As the name implies, non-mortgage asset-backed securities do not underlie any mortgage-related loans. Then, what do they involve? These are pools of such loans as auto loans, commercial loans, credit card receivables, personal loans, and lease receivables to name a few. These ABS are not backed up by any governmental agency and hence give rise to significant credit risk. Non-mortgage ABS can be structured as amortizing or non-amortizing following the structure of the collateral. When part of the loan's scheduled payments include principal payments, the structure is referred to as amortizing. So an auto loan ABS is an example of an ABS backed by amortizing loans. If the loan has no schedule for paying down the principal, it is a non-amortizing. A credit card receivable ABS is an example of an ABS backed by non-amortizing loans. Non-amortizing structures eliminate prepayment risk. We will look now at two examples. First, the auto loan ABS. Cash flows for an auto loan ABS stem from scheduled monthly interest and principal payments and any prepayments on the loans in the pool. Prepayments result from sales trade-ins, insurance proceeds, and early payoffs of the loans. As mentioned, these structures carry significant credit risk, therefore, the issuers resort to credit enhancements. For an auto loan ABS, the common enhancements include tranching, overcollateralization, and reserve accounts. Since auto loan-backed securities have a pool of amortizing loans as collateral, the ABS holders receive regular principal repayments and the outstanding principal declines over time. The second example is credit card receivable ABS. These ABS generate cash flows from finance charges on credit cards, where the interest is either fixed or floating, or from credit card fees, like late payment or membership fees, and finally from principal repayments of outstanding balances by the borrowers. In contrast to auto loans ABS, credit card receivable ABS holders receive periodic interest payments based on finance charges and fees during a lockout period, since the loans are non-amortizing. During this period, the cash proceeds from principal repayments by cardholders are reinvested in additional receivables. When the lockout period is over, principal repayments are paid off to the ABS investors. Let's take an example of an auto loan ABS. Suppose a subprime auto loan ABS has the structure showing on the screen. The ABS is divided into several tranches, 2 senior and 4 subordinated. Further, each tranche has a specific interest rate and scheduled final payment date. We are also given that the ABS has 2 internal enhancements, an overcollateralization with an amount of $10 million and a reserve account balance of $5 million. So, we can note the following. As long as the losses on the underlying loans on the first distribution date are less than the sum of the overcollateralization amount and the reserve account balance or $15 million, none of the classes will bear any losses. Should any loss over the cushion provided occur, the lowest ranked classes will sequentially take the hit. Assume, for example, that a first loss of $25 million was incurred. So there is a loss of $10 million above the cushion provided by the internal enhancements. Tranche E will of course be the first to be hit and will lose its full balance of $5.4 million. This means that there's still a loss of $10 million minus $5.4 million. That is $4.6 million that will be absorbed by Tranche D. Tranches A, B, and C will not be affected in this case. Find the full non-mortgage asset-backed securities and collateralized debt obligations video on www.CogniVisio.com.